So tonight I want to talk about creative financing. And you guys have heard me talk about creative financing strategies. I want to try to relate most of these to sort of current events, properties that we've recently seen, some deals that I may be working on. But I'm always thinking about how can I buy a property using creative financing strategies. I talked to about 3 different homeowners today, and each one of them, I asked them if they would be open to creative financing. Will you be my partner on the deal? I'll put up the money for the rehab, and I'll give you the money that you want, and then I'll keep the rest. That's an ovation. Or if you allow me to take over your mortgage, I'll pay you X amount up front and then X amount later, And so I look at every opportunity first to try to acquire it using creative financing strategies. That's just the way I think. And so I want you guys thinking the same way. And so I primarily want to use creative financing because it's just a lot less money down. When we went over that Cold Spring property, and I said the all-in amount, then minus the 20% down payment, with the creative financing, there's no 20% down payment. I mean, you get it at 10, 5, whatever you can negotiate. Sometimes no money down. And so that's why I like using creative financing. And then, banks aren't the new bank, a new mortgage company is not involved. And so you just really overcome a lot of the hurdles that you would have to using traditional financing. Generally speaking, when I've done creative financing, no one's checked my credit. Honestly, it's just a negotiation. Now, you've got to have a seller that's a willing participant. And so that's the biggest thing. You've got to convince them that it's their only option and it's their best option. And if you can do that, we have all the paperwork, all the contracts. If you can do that, then you can hit a lot of home runs using creative financing strategies. Now, generally speaking, on foreclosed properties, like the ones we've been seeing, the foreclosures, a bank is not going to do anything creative. And so we're using creative financing strategies for when we're talking to motivated sellers. When we're talking directly to a motivated seller, that's when we can use creative financing. Any questions so far? All right, understanding seller financing. The seller acts as the bank. A direct agreement is made between the buyer and the seller. You're negotiating the terms, and then it's mutually beneficial because, generally speaking, the seller either can't sell the property for what they want, or they don't want the tax consequence of a big lump sum capital gain and pay capital gain taxes. And so they rather defer that and hold financing. So I've had a lot of sellers say, yeah, I'll hold the financing now. I'm getting ready to retire because I don't want, because they sell a property and make 100, 200,000, that's a taxable event. So they got to pay taxes on that. And they're in a higher tax bracket. Once they retire, they're going to be in a lower tax bracket, and then maybe they'll want to sell later on. And so that's seller financing. They're going to hold the financing. And so let's say, for example, as an example, we looked at the property in Reservoir Hill, the one on Newington, that had I think it's 6 properties. They were willing to um, maybe throw in a 7th property. And let's say that they wanted 2 million for the property. Now, I don't think this is true, but let's just say that he owned them all free and clear. I don't think that's true. Do you guys happen to know what the mortgage balances were? Any clue? I know some of the ladies were able to talk to them a little more. Um, and Elijah's called me yesterday and today wanting to know, what we wanted to do. But what I would propose to him, let's say he said there's no mortgages, which I don't think is true. They wanted 2 million and some change. And so I would probably offer them either the 2 million or just a little less than that. Let's just say 1.8 and try to get them to hold the financing. So 1.8, let's just say 2 million. I'd give them the 2 million. They hold the financing, let's just say for 5 years. Put down maybe, let's see, maybe 10%. What's 10? No, 10% is 20,000. Let's see, 2 million. Let's do some quick math here. 2 million times 10%, 200,000. Maybe 5% would be 100,000. Give them 100,000 up front. That's 5%. So 5% down. I would do this in a letter of intent. I'll give you at 2 million, I'll give you 5% down, which means I'm financing 1.9. And then I would just work out the terms on that 1.9. I would try to get the terms as low as possible and see if they accept that. That's a scenario where the seller financing. That's a seller financing deal. Any questions there, you guys? Does that make sense? Good. So I explained it right. My first property I ever bought was in DC, and it was seller financing. But obviously the numbers were a lot lower. It was $50,000. It was a condo in DuPont Circle where they were selling it for $50,000. And my very first property I ever bought, they held the financing for 5 years. It was a balloon loan, and we worked out the financing. I bought the property. I rented the property out, and then in the 5 years paid them their money. So that's seller financing. Valerie, did you have a question?
No, I don't. Thank you.
Okay.
Hey Greg, this is IKEA. So I actually went up there, and he sounded pretty desperate. I would probably go lower than 1.9. He mentioned that he no longer wanted to do this. He partnered with the guy, and the guy died. So he was forced to get back in it. Um,
Yeah.
yeah, so just, FYI. He's over it, you know? So I would
No,
probably go less than 1.9.
he told me that they would be willing to throw in another property. But yeah, I would want to structure something creative, and that's probably what I will tell Elijah tomorrow. Because I talked to him yesterday. I didn't talk to him today. I actually forgot that he had called. So I will call him tomorrow, and I'm going to try to structure a deal. He said he wasn't sure if they were open to creative financing or not, but I'm going to make them an offer, and then see if they're receptive to it. And if he seems like he's receptive to it, I'll do a letter of intent. And so what I want to know is what's the balances? I want to know what the balances are for all of them. I want to know that. I want to know what the balances are. I do want 7 properties. 8 would even be better if they have an 8th, but I would want at least 7 of their portfolio. I want to know what the balances are because I want to take over the balances. So let's just say combined, the balances are, I don't know, I'm gonna throw out a number. I'm gonna say, because he's had them for a long time, 500,000. So 500,000 that they owe. So let's just say he owes 500,000. I want to take over that 500,000. I want the 7 properties, and then maybe offer them. I'll just say 1.8. But if he comes back at say 1.9, I mean, I'm not going to argue. So I would want to take over the mortgage balance of 500,000. That leaves me with owing them over time 1.3. Yeah. That leaves me with owing them 1.3. No. Yeah. 1.3. Right? I'm
So-
taking over 5. I'm offering 1.8. That leaves me with 1.3. So then my question is, what am I doing with the 1.3? They're going to want some money up front. So let's say that we give them, I'm just going to throw out a number. We give them 300,000 up front. So we raise 300,000, give them up front, or maybe a little less than that. Let's just say 1.3, and then ask them. I think his name is Jeff. Is his name Jeff?
Yes.
Ask to hold. So now I've got $1 million that I still owe them. I want them to take back a note for the 1 million. I want them to take back a note for 1 million. So I'll be paying the note, or me and my group will be paying the note on the 500,000. Now, hopefully, with the rents that are coming in, more than covers whatever their mortgage payment is on the 500,000. And then I would want to work out on the million, put them in second position. You hold the financing for the 1 million. I would want to structure a deal, something like that.
So Greg, when you say them hold the finance, that's the part that I really don't get. What do you mean when you say Jeff hold the financing means exactly what?
So what I just described is a subject to. So let's say the mortgage balance is 500,000. I want to take over the mortgage. So I want to buy the
Okay.
property subject to the existing mortgage. An existing mortgage, I'm guessing, I have no idea, 500,000. So now I'm taking over 500,000, but I'm buying it for 1.8. So the difference between 1.8 and 500,000 is 1.3. So now I owe them 1.3 million. You with me?
Right. Uh-huh.
I don't want to give them 1.3 million. I only want to give
Right.
them 300, let's just say 300,000. So I give them 300,000 down. Now that leaves, now I still owe them a million. You with me? I still owe them $1 million.
Right.
Instead of me going out getting a loan for 100 million to give to them, I'm gonna ask them to do the seller financing on the 1 million.
Okay, so that's the point I want you to get to. I understood the rest. The seller financing, what does that mean exactly? I don't really get that. The seller financing.
So I'll write up a note. I'll write up a note saying that my LLC owes you $1 million, and we're going to pay it in monthly
Time.
income. We're going to
Okay.
pay.
Okay.
We're going to
Okay.
pay you a mortgage payment
Right.
every month on the 1 million.
And so
Okay.
Greg, they could put a lien on the house. They would be second, right?
Yeah.
For the $1
Right.
million.
Yep.
Okay.
Mhm.
So Greg, that's two mortgages. You got to pay the first one directly, and then they create a mortgage, a second mortgage for you.
Yep,
That's what it is, Dana.
yep. That's called a
Right.
hybrid. It's a hybrid. It's a hybrid between seller financing. It's a hybrid between this, the seller financing that we just talked about, because they're going to hold a note, the second, and subject to. So we're going to do both subject to and seller financing on what we looked at on Saturday. That's the only way to structure that deal, in my opinion. And I would do it for 5 years. And then within that 5 years, I would want to do some renovations, clean up those properties, get them totally rented out. Hopefully within that 5 years, and then maybe add some more, force some equity and appreciation in there. I don't know what the deal is with laundry, with if there's any room to put like the coin laundry machines in a basement or whatever, but I would try to force some appreciation in there. And then in 5 years, try to double the value. Try to double the value, so that you either refinance and cash them out, pay off the first and the second, and pay yourself back and still have the assets, or just sell the whole thing in 5 years. That's the strategy.
So
What you-
if you sold, if the option was real quick, if the option was to sell everything, you wouldn't do it in a bundle like this. That's not the most proper way to do that, right? When you
I mean,
separate.
it just depends. It depends. If you, I didn't see the properties, but it's my understanding that they need work, or at least some of them. I mean, you can double the value, but at some point you need to pay them off. You need to pay off the first and then pay them off. And I would probably structure it so that I could have everybody paid off in 5 years. And then, like I said, either hold on, cash them out, pay yourself back, and then hold on to the asset. Or you could sell them off one by one, depending on what type of market you're in.
Right.
So Greg, you would pay the 1.5 million, or yeah, well, would it be 1.5 million? The
Off in
500,000.
5 years,
Yeah, in 5 years. That's what I was getting to.
Tell
right?
her how, Greg.
You said pay off what? But
So,
the
so the
total.
remaining the remaining balance is 500,000. Then you giving them 300,000 up front. So that's fine. We've already taken care of that. But the 1.5 million you would pay off in 5 years.
Yeah, I don't know what 1.5 is. So
But
let's just say that they have balances of 500. I'm just making up a number.
the 500,000, yeah, and then the other
500,000.
million, Greg.
Right. That's the 1.5 you're talking about.
Oh, I see. Yeah, you could do that.
Wow.
She's asked you where you're gonna get the 1.5 from. Let her know where you're gonna get the 1.5 from.
To pay it off in 5 years.
Either refinance,
That's what I was thinking. Refinance.
or sell the property. Sell them all.
Okay.
But if you're putting 300, using just these examples, if you're putting 300, you're giving the seller 300K, you're really paying off 1.2, right?
No. So
1.2.
let's just say the whole, I'm offering them 1.8.
Okay, yes, okay.
I'm offering them 1.8,
Mhm.
but 500,000, I'm just making up a number. 500,000 they owe. So I'm
Mhm.
taking that over.
Mhm.
So that reduces it to 1.3.
Mhm.
And then if we give them $300,000 down, here's 300,000. Now it reduces it to $1 million. So I'm asking them to finance $1 million
Got it, okay.
for me.
Mhm.
But let's say in 5 years, it's worth, those are worth, I'm gonna throw out a number, they're worth 3.6. Let me just see what the math looks like. At 3.6 divided by, let's just say it is 7. Yeah, let's just say in 5 years they're worth $500,000 a piece. Then it's a great deal. It's a great deal. That's
Maybe-
seller, but the best part of it all, we got no bank financing. That's the best part of it all. We didn't have to go out and get any bank financing.
How many houses is it, Greg?
They initially offered 6, they're all multifamily in Reservoir Hill, but then he said, we would, if you give me the 2 million, well, he has a big package. A big portfolio. He said, we'll throw in another property. So 7. So 7 for 2 million.
And
Which-
what do
which
you
comes up-
what do you expect, Greg? What do you expect the retail on price for each one of those? Or they're different, like they're not close. Like some are good, some are bad.
We didn't really have the opportunity, at least I didn't, to inspect them all. But at 7, they're selling them for about 285 a piece, 285,000 a piece. With 7 properties.
And that's Reservoir Hill.
Yeah.
Right
That-
down on North Avenue, but below Reservoir Hill, Ryan's building houses now in the 4s right there. A
Yeah,
brand
he
new
had mentioned
development.
that, yeah, he mentioned
Right.
that too.
The value is only going to increase in that area. You are not going to see a downside in Reservoir Hill. You will not. So
So Greg, those places have not been renovated. He did disclose that. They have, in 40 years, they have not been renovated. So at some point, you might need a renovation to take place.
No, we definitely will. And I'm just throwing out these numbers for the sake of the lesson tonight.
Yes.
We would make the offer, we'd do a letter of intent, maybe with these numbers. We would do a letter of intent. We would have an inspection period, feasibility study. And guess what we do? We come back after that study period, and guess what we say? Somebody tell me.
We need to negotiate.
Need to come
Sir, Mr. Jeff, we need to negotiate. We found some issues.
What are we negotiating at, Dana?
Well,
We
we
had-
negotiate that. Well, we had to talk about that, but we definitely need to negotiate.
We definitely need to negotiate.
You know, the repairs, it could be renovations, all that's a lot. And let me say this, also shared that he might be in tax trouble because of the way his partner was conducting the affairs throughout.
he told
He
you
shared that
all
as
of
well.
this?
Yeah, he
Wow.
was talking about capital gains.
Wow.
Yeah.
And Greg,
So-
that house has a water issue too.
Where is that at? I didn't see that. Where was that?
Yeah, I don't remember.
We spoke to the tenant.
Oh, okay.
From the roof, you mean? From the roof?
No,
per
it's the
unit.
water system.
Yeah, from her unit
we-
down to the first unit. There
Oh.
was.
Well,
there's
that's
been
what I'm
some
saying.
water
That's
issues.
old plumbing, old electric, all that. That's what I was talking about as far as the renovation costs.
I tell you one thing, if we could get the number down to 1.75, that's about 250,000 per unit. That's a good number. 250,000 per unit.
You think ARV on one of those units, the one we went in, we think would be what?
I'm thinking around,
Just a guess.
I'm guessing almost 400, 390 maybe, 390.
Oh, yeah.
Right
So
now,
Greg,
right now, and as is value, about 390.
so
So-
Greg, if you had to put something like that together, well, would you do that as a joint venture? I heard you say we.
Yeah,
So
I would bring in some partners.
Would be a dollar amount requirement? What would that look like?
It just depends.
Okay.
It
I
just,
would like to be part of that if the time was right.
okay. Yeah. And then you guys told me that he had a 22 unit too, right?
Yeah,
I didn't hear about that. Well, I heard one of you guys tell me, but I don't, is that one right there also in Reservoir Hill?
it was like walking distance because when we left, he was like, all right, we're gonna go there now. And then, so I think it was like walking distance.
Wasn't it
So,
at the corner?
Oh, I don't remember, but I know he looked like he was ready to start walking there. So
Right, right. He was.
so that may be something to negotiate as well. All right, so what I just went over subject two. So subject two is if there's an existing mortgage, which he has an existing mortgage, obviously, taking that over. Putting that into the best way to do it is put it into a revocable trust with both names on a trust. So now there's nothing can happen. He can't come behind your back and sell the property or anything like that. So we're putting that in a trust. And then when you're doing a subject to, oftentimes we'll do a subject to and we'll give them money and then that's it. We're just taking over the mortgage and giving you 10,000 and that's it. But then there's also times like this one when we're taking over the mortgage, but there's a huge difference between what you negotiate in price and what the mortgage balance is. We never want to pay the difference. We want to negotiate that too and let them hold the financing. You guys understand that?
Not quite. The mortgage balance.
So the difference between, so in this case, the difference between, let's just say 2 million. The difference between 2 million and the mortgage balance of $500,000, the difference is, let's just say it's 1.5 million.
Uh-huh.
You're not going to go out, you shouldn't go out, you can go out and get a loan for the 1.5.
Oh,
You
I see.
negotiate that 1.5 and let them hold the
Right.
financing fee and do the seller financing on the 1.5
Right.
minus whatever you give them down. You got to give them something. They got to walk away with some money. So I was just
Right.
thinking 300,000, but could be less than that.
Mm.
You guys with me?
Yep.
Any questions on what we just talked about, you guys?
For these
right.
kinds of, I'm sorry, Greg, for these kinds of deals, it's best to talk directly to the seller, though. I mean, in some cases, you're going to have to deal with, like in the case in Aberdeen, the agent had no clue what I was talking about, but the seller did because she was in the business. So,
The agents can kill your deal
yeah.
because
That's for sure.
they're not familiar with creative financing. A lot of people, investors aren't. Some investors aren't. All right, lease options. And so a lease option gives you the right to purchase the property. And so that's also a good strategy. So you want to rent with the right to purchase later. Investors and tenants win. And so I'd like to have in my lease option the option to purchase, but also I want the option to sublease as well. Because if possible, I want to sublease the property out to somebody for an amount that's more than what my rent is to the landlord. So I'm gonna do a sublease so that I can have cash flow. So I'm getting cash flow without actually owning the property. That's the lease option. And so my first house in Prince George's County was a lease option. I actually lived in the property, but I did a lease option for 2 years, moved into the property. For me at the time, I was like 30 years old. It was a dream home. It was a dream home for me. And then after the 2 years, I was betting on myself for the whole 2 years that I'd be able to qualify, because at the time I didn't qualify. And then I qualified and bought the property. And so, but as an investor, I think it's a good option because you control the property. You just have to know that after the 2 years, you're going to be able to get a loan and get it financed. That's the only thing. And that's why I've seen people fail. Because you should be on a lease option, you should be either putting down a deposit, or part of the rent you're paying goes towards your deposit, which is non-refundable. So if you don't buy the property, you lose the deposit. If you do buy the property, the deposit goes towards the purchase on a lease option. So that's always an option as well. You don't own the property, you're just controlling it. You have it under contract on a lease option. And so that's also a good option for you guys. Any
Great.
questions?
Yeah,
ahead.
good question. Can't you lose the deposit, like if you get behind on the rent and all that stuff and they're ready to evict you, you can lose that deposit too?
Oh, yeah, absolutely. Absolutely. Yeah, if you don't, anything that causes you not to purchase the property, you lose the deposit.
So
Another
Greg, I have a
thing-
question. Oh, go ahead. I'll wait till you finish.
Okay, great. I know, like, with the Airbnb hype that was going around like a year or so ago, a lot of internet real estate gurus were pushing that, as far as not buying the house, but using it as an Airbnb and never owning the house.
Yeah, it's called a master lease. They were getting master leases to or corporate leases to do a lease option, never owning the property, being transparent, letting the owners know what was going on, but taking out like a 5-year master lease, and renting those properties out and subleasing them as Airbnbs. And some people got up to like 60 to 100 properties, never owning them, but taking advantage of the cash flow. But yeah, that's what a lot of them did. And they were selling courses and things like that. Like you're saying, to your point.
So question, why would an owner allow subletting? Am I saying that right? Why would they allow that when they could be making that extra money themselves?
So they're not doing it right. They don't know what they're doing.
Well, sometimes Airbnb is very hands-on, and some people might not want to deal with that. It's like running a hotel, basically. As soon as the people move out, you got to go in there and refurbish everything as far as sheets, towels, all this other stuff, cleaning it out. Some people don't want to deal with that intensity.
I mean, it's very easy to put a clause in your lease that you may not sublet my house. That's what I did because I didn't want that drama. So no, you don't get to sublease and make money off me like that. No.
Exactly. That's what I'm thinking.
Very
If
easy to do.
extra money, if there's extra money to be made, if they can rent it to person A, then person A rents it out to person B for more money. Why can't they just rent it out to person B to begin with?
Because
I'll be
Karen,
the one.
I mean,
I'll be the
Valerie,
one to do that.
everybody doesn't have the wherewithal to do that. Everybody who has a house doesn't have the wherewithal to do that.
Or the resources that we have.
Right.
If they're happy to rent it out at, for example, $2,000 a month, they're happy there, then fine. They're getting their money, they're happy. And then, but if we know, because we're in the business, that it could really rent out for, say, 2,500, why wouldn't we do so we would do a lease option with also an option to sublease, make $500. I would think that everybody's happy.
So Greg, if it's okay, I'd like to lay out a real life scenario for me, and hopefully it'll be helpful to the group as far as rent with the option. So in my condo in Southeast, I just moved a tenant in. He is looking for employment, but he has income, veterans income. He said he would like to buy the house. He would like to buy the property, but he's not ready yet. Would it be a good idea? Because I really would like to get the money out of that and use it for something else. Would it be a good idea for me to try to do that now, get him under rent with the option of purchase now?
You said it, you've got someone that wants,
So someone is renting just a month ago, I moved somebody in my condo, but he said I would like to buy it. And I would like to sell it. So should I try to get him under a rent with the option now? To lock him in? And if it doesn't go right, I'm still all right.
yeah, is he saying that he wants to buy, but he can't buy it now? Is that?
He's not ready, but he can't get financing yet because he's finding employment. He has income from VA, but he doesn't have a job. He's trying to find a job, locking a job.
I mean, Dana, I would say as long as you're okay, knowing that, let's just say you give him 2 years. As long as you're okay knowing that in 2 years, he's not going to be ready, then I would say go for it.
Okay.
You
Yeah,
do
because I
do a
can't
lease
lose,
option.
right? He's gonna be the one can lose. I can't lose. Is that correct?
No, you can lose because
Oh.
now he's going to want to move out, and so now you got tenant turnover.
Hey,
Oh, well,
Dana.
that's not.
Hey, Dana, he's gonna have
Yes.
to give you a nice down payment too. So that would be
Yes,
a win-win for you.
That's
Yeah.
well, great. That's what I was thinking. How could I lose other than the turnover, which I don't mind? How could I lose? The
You
reason,
can
Greg,
miss,
I don't
Dana,
mind
you
because
can
I
miss,
do.
you can miss out on another buyer wanting to buy it.
Oh well, there's reasons why that's not a concern, but we won't go into that right now. But Greg, the reason I'm not afraid of turnover because it's a condo and I can do the work myself. You know, I'm not paying anybody for renovation
I
costs.
mean, as long as you know what all the pitfalls are, unfortunately, I can guarantee you he's not going to be ready. If he's not ready now,
Right.
that's the downside of lease options. And hopefully I've said that before. Most lease options don't work out because they're not ready. They're not qualified. They're not qualified now. They're not going to be qualified in 2 years.
But my point is the tenant loses out and not the owner, right?
You both lose.
You both look.
Well, I can't
So
say
Dana, this
can't
is
say how-
Karen. I just have a question. So he's telling you now that he can't afford it. Would you wait? Would you consider waiting for maybe like
Sure.
6 months?
Sure, I'm fine. I'm fine with it right now. Yes, I'm fine holding it as long as he's paying his rent. I'm fine right now. But eventually, I do want to unload it and use that money elsewhere. So I'm not pressed
Yeah.
to sell it right now. Is what I'm saying.
So
Understood.
I wouldn't. So the answer to your question now is don't do it.
Okay.
Because there's no reason to do it. If if he's paying his rent, you're comfortable with him paying the rent, why change anything?
Because that's a way of me locking a tenant in for 2 years. Is what I'm saying.
No, he's locked in already. He's not
No,
moving.
he's not. He's not locked in for 2 years.
Well, you just signed a 1-year lease.
Yes.
I mean, we can talk offline,
Okay, we'll talk offline.
but I don't
Hey.
know that I would do it.
Hey, Dana,
Yes.
Dana, I would leave it as it is as opposed to do a lease to own. And 2 reasons, if he can't qualify in 2 years from now, you risk him becoming a squatter. And DC is tenant friendly. They're not.
I got that. So Millie, see, I'm glad you spoke up. So why would him not qualifying create that squatter scenario if he's been paying his rent the whole time? Why would that?
Yeah, he can pay his rent, but what if he decides or he can't pay his rent? Then you get into you get into this thing where you got this other option. You gave him the option to buy, which puts a different set of scenarios than just the basic, tenant and eviction, because now you've got a contract. So he's breached the contract, but there are other clauses in DC that may allow him to stay longer
even though
I got you.
even though he breached the contract.
Oh, so
So
you
you
saying
don't want,
because of that contract, you mean?
yeah, yeah,
Oh,
that
okay, that's it right there. All right.
you don't
Okay.
want to, you don't want to set yourself where you bring in more problems because
Yes,
of
I
the
don't
type
want that.
of.
That's
And
correct.
then the last thing I'll say, and we need to move on, is people change over time.
Yeah.
You guys saw the second property Saturday. That tenant was the perfect tenant till the bitter end. And then at the
Right.
end, you see how she left the property.
Yeah, yeah, yeah,
She
yeah,
was
you're right.
perfect. She was she was what you would consider, Dana, the ideal tenant
Right, really.
until the bitter end.
She's the one I've been bragging on, Greg. You got some good tenants over there.
She changed her number. I couldn't even get a hold of her. And then you see how she left the property, the food in the refrigerator. You just never know about people.
So I hope that scenario was helpful to everybody because it helped me. I got my answer, so thank you all.
You owe us, Dana. All right, hard money, private money. We I think we've talked a lot about hard money lenders. Hard money lenders, a lender that's qualifying you basically on the merits of the property, not necessarily, well, they kind of do now, the merits of you personally. Now they're running your credit for the first time. Now they're looking at past performance or not. They're giving you a higher percentage down if you don't have past performance. So that's a hard money lender. It's short-term financing up to a year, and interest rates are some you can get like 8% in 3 points, 10%, numbers like that. Higher than what a conventional lender would do, and it's short term. A private lender is similar to a hard money lender. Hard money lender is they've set themselves up as a business. A private lender is basically the same thing, but they're just individuals that are lending money. Their terms aren't as stringent. They're generally not checking credit, things like that, with a private lender. As you move on throughout your real estate investing career, eventually you're going to want to seek out private lenders, as I have throughout my career. And then there's tons and tons, really, if you investigate, of private lenders out here that I will be hopefully, prayerfully, I'll be bringing to the table for us. And so when I say raising 300,000, you could get private lenders to be a part of that as well. So that's hard money lenders, private lenders. I know that Derek just got approved through a hard money lender in Baltimore called Pimlico. He just got approved through them. And so that's what a hard money lender is. And so you can combine the two. So oftentimes on my flips, I would get the acquisition money and the rehab money from a hard money lender, but I still need money for closing costs. I'd get the closing cost money from a private lender, so that I'm flipping properties using none of my own money. So you can combine the two. Any questions there? Just about all the flips that I do, I combine the two. So I don't come out. So the money that comes out of my pocket, I kind of reserve that for change orders, things that may go wrong during the flip, things like that.
I have a question. So with the private lending, that contract comes from where? That that agreement between you and your private lender comes from where?
Well, it comes from you. It can come from you. You have a promissory note in your toolkit.
Okay.
So you do a prom note with them. And
Good.
I can help you fill it out. But all of
Okay,
you
good.
guys have promissory notes in your toolkit.
Okay.
Greg, follow up on that, because of course the private lenders are going to want to know when they're getting paid back and how. So if we go that route, can we work with you to kind of help do the math around that? Because you got to be able to afford to pay them back too.
Yeah, I mean, so you pay them back, the private lenders, on a flip, you pay them back once you've
Once you
completed,
flip the house.
once you flip the house. And so what I put in mine is I'll pay you back in 12 months, or when 123 Main Street closes, whichever occurs first. Is what's boilerplate in my agreement.
Okay.
And
Thank
we
you.
were having a conversation about this, and what I was offering is that most private lenders gonna want their money within at least 12 months. Is that correct? They're not gonna go a long term, right?
Yeah,
Right.
that's correct. All right, joint ventures and partnerships. And so what I like to say about joint ventures and partnerships is, I want you guys to think about doing these, or we need to be doing these amongst ourselves or in smaller groups. I want you guys to bring something to the table. I want you to look at yourself and say, if I was to partner with someone or do a joint venture, what am I bringing to the group? Can I find the deals? Do I have money? Do I have good credit where I can help finance the deal? Do I have contractors that can help? You know, what are you bringing to the partnership or the joint venture? Because one thing I found in my career is joint ventures work. You can scale a lot faster. You can do more deals a lot faster. You can acquire, like what we were talking about with Reservoir Hill. You can acquire properties that you could have never acquired on your own. But you want to make sure that you're contributing to the partnership or the multi-member LLC. You're contributing in some sort of way, because you don't want anyone disgruntled that's in the partnership. Like, you want it to go smooth and everyone's happy. All the responsibilities are written out, case of death, all kinds of stuff. All that needs to be written out in the agreement. And so we need to be doing partnerships because we can do more deals a lot faster. Now, I will say that flipping properties is a great way, just like I just described on how I do them, is a great way for partners. It's a great strategy because you're kind of in and out. You get to know your partners. You're not with them for a long time, that kind of thing. Or doing like the 22 unit buildings, the 7 units, things like that. Situations where you couldn't have done them yourselves, but you've pulled you've pulled money together, or you've got one or two that have the credit and the wherewithal to get the financing. You can have limited partners. Some people can be the main partners, others the limited partners, that kind of thing. And so that's what partnerships. And as time goes on, we need to form partnerships to be able to buy some of these properties.
Great.
Any
Yeah, I
questions?
got a
Ben?
question. Speaking on what you're speaking on, how is you guys, I know you have a list with everybody that's in the group, emails, phone numbers, and all that, so we could like stay in touch.
Yeah, absolutely. And I think that's sort of the value of us getting together, like this past Saturday and other times where we have an opportunity to network with each other.
Yeah, I was sorry I missed it. I was out of town. I just got back, so I
Well,
missed it.
you were having fun.
Yeah.
So, and so that's joint ventures, that's partnerships, and those are some of the things I want you guys to start thinking about. Any other questions here? Lines of credit and business credit. And in terms of what we just talked about, some of you guys do have the wherewithal to get lines of credit and business credit that you can bring that you can bring to the group, or that's your contribution, depending on what your credit is. I'll bring some people in, and I think one of you guys told me you know some people that can talk to us about business credit. But some of you guys know Lyric. Some of you guys know Lyric Hawkins. She knows a lot about business credit. I'll bring her in to talk to us about that. But getting lines of credit, business credit, can help in terms of you being a partner. Wholesaling, we talk a lot about wholesaling as a creative strategy to buy properties. I mean, to make money and not have to go out and get a loan. You guys know wholesaling. I won't spend a lot of time there, but you're finding deals, and then you're assigning those deals to cash buyers for quick profits. That's wholesaling. Raising private capital, and there's some people that do that. And so some of you guys have heard of express home buyers. You guys heard of express home buyers? So my buddy Brad owns the company, and all he does, not as much anymore, but back in the 90s and early 2000s, all he did was raise money. That's all he did, was raise money for his deals. And that's all he did, was talk to private lenders and raise money for his deals. And so that's kind of advanced, but that's something that we can be doing as well. All right, the Burr method as a strategy. Hopefully you guys have heard of the Burr method. I think I talked about the Burr method at the 4-day event. So Burr stands for buying the property right. And so in order for Burr to work, you got to buy it right. You got to buy it within the formula. You got to buy it at least 70% minus repair costs. You've got to buy it right. And then we're going to rehab the property. We're not going to over rehab. We're going to rehab the property. We're going to rent the property out. And then we're going to refinance the property, preferably with a DSCR loan. And so what I try to do is refinance in a way that I still have 70% or 30% equity in the property, at least 30% equity in the property. So my mortgage balance that I owe, the balance that I owe is at least I think I'm saying this right, 70% of the ARV, of after repair value, 70% loan to value. And then I need my mortgage payment to be 70%, 70 or 80% of the market rent. Now, if you can get those numbers, you can refinance, and the mortgage company's not going to ask you for any money down. They're on the DSCR loan, they're looking at the financials of the property. And they want your payment to them to be 70% of the money coming in. So the easy example is your mortgage payment to them is $700, but you're collecting $1,000 in rent. As long as your numbers are there, and as long as you've got enough equity, you're doing the refinance in some cases, getting money back. You can do a DSCR loan and get money and cash out. And then,
Greg,
go ahead.
sorry to interrupt. Yeah, but Greg, that comes from really commercial where that DSCR, debt coverage, debt service coverage ratio, and that they would lend, like if we were doing the numbers for a multifamily, that the mortgage rate, the mortgage payment, like you said, they would use a factor of 1.25, meaning that it had to be at least 25% over what the mortgage would be.
Yeah, it's somewhere between 20 and 30, depending on your credit. But yeah, and so if you can do those numbers, then they're not only will they finance you and you don't have to come up with any money, in some cases you get your money back and then you rinse and repeat. You repeat the process. That's what BRRRR is. Buy it right, renovate, rent, refinance, and then repeat the process. And so that's like the best thing coming, but it works best in a market where interest rates are a little lower than they are now. So I don't see a lot of people doing BRRRR now, but once interest rates get lower, then you'll start to see a lot of people doing the BRRRR method.
Greg, is there any workaround? So I spoke to a handful of like hard money lender and even like some DSCR lenders, and they're like your loan amount has to be more than 100K, right? With like in Baltimore, there are some places you can acquire, and even with rental costs, or if let's say you pay for rental out of pocket and the loan amount is under 100K. Like, is there any workaround or how, like, yeah, how do you make that work? Or do you know any lenders who loan where the loan amount is smaller than 100K?
Right, you have to go to private lender route. Private lender, maybe 2 private lenders. You got to go that route. That's the only way you can do it. I talked to a guy today. He's got a property in Brookland in Northeast DC. Talked to him today. I'll be meeting with him. He's got a row house there. He says I asked him, I said, Mr. Seller, do you have an idea of what you want for the property? He said, I want the tax value. The tax value was basically 500, was 504. And I said to him, the ARV was, the ARV is 780. So ARV is 780. He wants 500. And I said, well, the numbers don't work for me as an investor. The numbers just don't work. But if you'd be willing to or consider partnering with me, allowing me to renovate the property on my dime, allow me to put it on the market, I will give you the 500, and then everything over the 500, I get to keep. And he said, I'm open to that. I'm open to that. And so I will be meeting with him. And if he's open to that, now my real number is, I'd like to get him to 480. So if I can get him to I'll sign a contract at 500, what he wants. But I'm gonna try to get him to 480, because if I can get him to 480 and ARV is 780, then I'm going to put in, I'm guessing he still lives in the property, he's in the process of moving out. I'm guessing it needs somewhere between 60 and, depending on if he's got an HVAC system in there, maybe 80,000. I'm just going to guess and say he needs between 60 and 80. I can put between 60 and 80 into it, not have to go out and get a loan, put it on the market because it doesn't fit my formula for wholesaling, put it on the MLS to be sold, give him 480 or the 500. If I can get the 780, then I will make good money.
So Greg, you said that's a DC property?
Yeah, that's called a novation. Yeah, that's a DC property. And so
So, wait.
no, go ahead. No, what I just described is a novation, but go ahead, Dana.
Okay, Greg, so on novations, I've been really considering novations lately. That's really been on my heart. Can you go over all the things that could go wrong with the novation as far as in the sense of it being a novation? After you put your money into that repair, into that renovation, can you go over what things that could go wrong?
The things that can go wrong, as far as I can see, is you want to make sure before you get started that all the title work is done. You want to make sure that you check for judgments and liens and all that. So get that together. And then the other things are you want to be 100% sure on your after repair value and 100% sure on your rehab costs. Your numbers have to work. Your math has to be on point. I've done two, and they didn't. And you guys saw them. You guys saw Summit Street. You guys remember Summit? Remember that one?
Is that the one in Trinidad?
Yeah. So I did
Okay.
Summit in Trinidad, and it was successful, but not as successful as I thought it would be. But I did get out of it, made just a little bit of money. And the mistake I made was I overestimated the after repair value.
Okay.
If you can remember there was some like steep steps going up.
Yes.
And my thought was, once it's renovated, I can list it for a little lower, and that will overcome a little lower than the after repair value, and I could overcome those steps. But I was wrong.
Right.
I guessed
Oh,
wrong.
oh. So,
I
okay.
still got out of it. I mean, they still bought it, and I didn't make as
Well,
much
but
money.
it was probably the steps in the HVAC system that you couldn't see as well.
No, HVAC was fine, Dana. HVAC was fine.
Okay.
They
Couldn't see it though. It was hidden. But okay.
had a home inspection. Everything was fine.
Okay.
Actually, everything was perfect. I mean, it was a really nice. We did a good job on it. But those are the only things. Those are the only things.
But you think it was the steps. That was the thing. That was the
Yeah.
killer.
Yeah. I mean, that's why it couldn't sell before. So it couldn't sell before. My agent listed it, couldn't sell it, asked me to come over and just take a look at it. I said the reason why it's not selling is it was dated. And the seller said, well, I don't have the money and the steps. And
You
so,
you could put it in the back though, right?
yeah, you could come through the back.
Yeah.
But you shrink the pool of buyers that are going to want to come through the back. So luckily,
Right.
we found a buyer and they bought the property. They actually bought it using HPAP and they got a ton of money from HPAP. But anyway, just your numbers just have to be right.
Right.
But it's a great alternative to wholesaling where you're listing it on the open market with some renovations. And then I don't think moving forward, I'll renovate at the level that I renovated that one. Like I put in recessed lighting. I mean, it was a really nice renovation. We painted the cabinets to make them brand new. We put in granite. It didn't have granite. We put in new flooring. Like I mean, it was really, really nice. You guys remember?
Those new bathrooms too, right?
Yeah, staged it. And so I don't know on a novation, I will do that level of renovation anymore. But the numbers just have to be right. And so I'm hoping on this one in Brookland, number one, he agrees. And then number two, I think my numbers are right though. And then I did talk to another seller today. They have a property on, you guys familiar with 16th Street Heights? You know where that is in DC?
Yes,
Yes.
Carter Barron.
Yeah, up that way. House on Buchanan Street.
Mm-hmm.
They ARV is about $1 million. She was at 735. She's already lowered to 690. So she's at 690. ARV is $1 million, and that's being conservative. And so I'm gonna try to do the same thing with her, a novation.
Greg, why didn't the numbers work? All because of the rehab, the level of rehab the house needed?
On which property?
The one you were talking about a minute ago.
The one in Trinidad, it had steep steps. Like you had to come up these steps that was real funky, not normal. And
Out front? You mean out front coming up to the house?
yeah.
All right.
Mhm. Yeah. So I thought I could overcome that by renovating the property because they were selling it and it wasn't renovated. And so we went in and renovated, and it, like, I guessed wrong, but not to the point where I lost any money or anything, but it was a learning experience. But that's the novation. To novate means to replace. And so you do a contract with the seller, and then you replace yourself in that contract with an end buyer from the MLS. Someone's going to live in it, not a cash buyer that needs to buy it at 70%. We're probably selling not at 100% market value, but maybe just below that.
Can you go through how you calculated your numbers on that deal?
I didn't really calculate like we talked about, like at 80%. On which deal? The one in
Property, yeah, that you said with ARV 780, you wanted to get them down to 480, repairs between 60 and 80.
I didn't like run a formula or anything, but
Oh, okay.
let me do one real quick. And so he said he wanted 500. But I'm going to do it at the numbers that we talked about. So at 780, 80% of that, I'm at 624. So I'm probably right on. I'm at 624. Let's say it needs about I'll see it, but I don't know. I'm gonna say 80,000 in rehab. So I'm at 544. I'm at 544. Buying it for 544 at 80. If it needs 60,000, I did do the formula, I remember now. At 60, I played with the numbers. At 60,000 in rehab, I'm at 564. I'm at 564. So if I can get him down to 480 at 564, I make $80,000 on that deal. So I used 80%. So on a wholesale deal, and I'm glad you said that, Alicia. On a wholesale deal, you guys, our formula is 65% of the after repair value minus repair costs. On a novation, I want you guys to use 80%. 80% of the after repair value minus repair costs. But just remember, on a novation, you're not assigning the contract to a cash buyer. You're selling the property to an end buyer. That's the difference. You're selling it on the MLS to an end buyer. That's the difference. So Alicia, I did use 80%. All right, you guys, any questions?
Keith, Greg, I'm curious to know, any of these methods work best for reverse mortgage, or does that matter just as long as the numbers work?
Yeah. Just as long as the numbers work.
Hmm.
Like, I think for you, I think I wouldn't use the word reverse anymore.
Okay.
I think it's confusing. All it is just a mortgage balance, whether it's a reverse mortgage, whether it's a short sale, whatever you call it, we just need to know what the mortgage balance is.
Mm-hmm.
And then we run our formulas.
Got it.
Don't get confused with the terminology. It's just a mortgage. And all we
Mhm.
care about is what that mortgage balance is. We don't care what kind of FHA mortgage, conventional mortgage, it doesn't matter. All right, any other questions, you guys, before we wrap up? So I want you to know about creative financing. And then ask me when you find a deal, is there an opportunity to use one of these strategies? And if so, let's use one of these strategies because it's going to save you a lot of money. So it's like thinking, how can I creatively buy this property and save as much money as I can so that I can buy the next property? And I can buy it creatively and be smart about it.